Ed Yardeni, David Costin, talking about up we go. You agree?
I do agree, and mostly this is predicated on what's happening with bond yields, the bond market, and the massive liquidity we have, and the caution of the Fed. There is no place else to go. You have to be in equities, and ultimately the recovery's here. And the unemployment picture will get better moving forward. I think it's pretty clear that the rolling off of unemployment insurance in those 26 states has been a benefit to those unemployment numbers, and we'll see that for the rest of the country as teachers go back to work. So we're really moving forward here, despite this really mysterious Delta variant, which seems to have a 45-day spike. Very strange. But it does appear to be rolling over here in the country. The question is, does it really smack the Northeast in the autumn? And that's kind of the risk here. But other than that, if we're just talking about markets and liquidity, it's all systems go.
Couple of pieces to that puzzle, Alicia. Let's start with your call on the labour market. That recovery, my question, how expensive will that recovery be? I'm thinking about wage growth. And what will that mean for margins on the S&P 500?
So it's really interesting. If you look at the states where the unemployment benefits have rolled off, the wage growth has slowed in those states. And so essentially the federal government has become a competition with private industry right here for labor. As that rolls off, I suspect you're going to see a slowdown in wage growth, and that's going to affect the inflation picture. And by the way, the bond market's telling you that, right? So the pricing of inflation is higher in the short term, lower in the long term, and well within the range of where the Fed is comfortable and, frankly, where the Fed's targeting. So the market's all in on that. And, of course, the risk is that it doesn't happen, and then there will be a convulsion. But, to the extent that that story holds, I think we're good. We're coming into two important inflections. September 6th, where unemployment insurance rolls off and teachers go back to work. That should be a very nice bump for 2 months into the jobs numbers.
Alicia, Lisa's going to want to follow up on the final point. Let's just work through it together. Those couple of points you made at the start of that comment. 1, labour supply recovers. 2, inflation decelerates. Let's get to 3. What does it mean for what you want to own in the equity market in a decelerating inflation environment?
So look, we've been calling this mid-cycle for several months now, which means you want to own quality. So the easy gains in some of those junkier companies, that's over, right? Those spec names where you're trading 40 times revenue, that trade is over. You want to own quality here. You want to own earnings power, and you want to earn cash flow. And those are the stocks that will outperform here. So what does that mean? That means a lot of sectors can do really well, but you want to be a little bit more focused. You can't just throw a dart at the board anymore, which is what you could have done, 15 months ago. So you want to own quality earners in every sector. Cyclicals, we like cyclicals here. They've sold off because of the skepticism of where we were going. We'd look at the companies, not so much the headline ones that have rallied on the infrastructure bill, but some of the mid-cap ones that haven't really moved yet. And we'd also like tech here. We like software here. And on top of that, we think you have to add healthcare, because healthcare is some of the steady growers here. Again, Delta is a risk. Very hard to model this out. But as I've said to you guys many times, for the most part, the market is looking through this as a short-term phenomenon.
Although we have heard from corporate executive to corporate executive that the supply chain constraints are lasting longer than they had expected. Now we see the disruptions in China leading to further delays in shipments. How does this factor into higher prices, into margin pressures, aside from the labor costs that you see subsiding?
So look, it's the inflation issue and the supply issue is clearly lasting longer than expected. But what we've seen is the market's comfortable with this. So transitory does not mean months. It probably means quarters. And the same with the supply issue. But for the most part, the market is comfortable with this, and margins for second quarter earnings are still coming in pretty high. So we're seeing some noises of it, but I think it's too early to call it a trend. And if you look at some of the travel companies that are predicting slower growth in the third quarter, this is not a disaster. This is a blip. And this is really a hiccup on the way forward. And that is how the market is taking it. Now, of course, the huge risk here is inflation lasts longer and it's higher than that transitory number. I think that is a risk. But ultimately, you're not going to get 5% year-over-year inflation growth forever. It's probably going to come down to about a 3% rate.
Are people,
definitely higher than the post-global financial crisis period.
very
Higher.
quickly, Alicia, are people enthused? I mean, you know, BNY Mellon, you've really got a sense of institutional, high net worth, and retail. Are people enthused, or are they numb as we are?
So I think that people are cautious, right? So, you know, we're sort of naturally cautious when you see markets like this. But I think the thought that the earnings are going to carry us. And to that extent, the market is less risky because actually the market is cheaper. And so earnings are extraordinary. You will see numbers coming up for 2022. Despite any thought of tax increases, numbers will go higher. And so that's going to carry the market. And with it, there'll be a bedrock to price action here. So that's why I'm bullish. I mean, it doesn't mean you can't have a 5 to 10% pullback. We haven't had that yet. That's pretty extraordinary. But, you know, the direction of travel is upward.
Alicia Levine, thank you so much.